Hello and welcome to the Global View on this Wednesday. I'm Andrew Gagan. Good that you could join us again here at Ausbiz. So let's get across what we saw overnight, with equities mostly falling along with bond yields and the US dollar, as investors refocused on a slowdown in global economic growth, while traders are becoming impatient for a resolution on tariffs. On Wall Street, the major indices finished in the red as tariffs again weigh on equities. This after President Trump said he would announce levies on pharmaceuticals in the next 2 weeks. That saw healthcare as the worst performing of the 11 major S&P sectors, with Eli Lilly and Moderna both falling heavily. Meanwhile, Ford has suspended its full-year financial guidance and warned that auto tariffs will take a toll on profit, with the company's total tariff impact forecast to be around $2.5 billion US. Shares of data analytics firm Palantir tumbled, with investors unimpressed by the company's modest revenue beat and profit. US hotel operator Marriott trimmed its full-year revenue forecast as tariff-induced uncertainties and federal spending cuts hit demand, the company highlighting a 10% drop in nights booked by the US government. And Constellation Energy shares surged after its quarterly results. Well, the US trade deficit has soared to a record $215 billion US as imports flooded the country to beat the tariffs. Meanwhile, US Treasury Secretary Scott Bessent has said the Trump administration could announce trade agreements with some of the largest trading partners as early as this week, but gave no detail on which countries were involved. And President Trump has met Canadian Prime Minister Mark Carney to discuss the trade relationship, with the newly elected Canadian leader telling his US counterpart that Canada would never be for sale. And Britain and India have clinched a long-coveted free trade pact after those tariffs forced the two sides to hasten efforts to increase their trade in whiskey, cars and food. The deal between the world's fifth and sixth largest economies aims to increase bilateral trade by a further $34 billion US by 2040. Well, US Treasury prices have risen, pushing yields lower, while a well-received auction of the benchmark 10-year note suggested demand for Treasuries remains intact, boosting other maturities across the curve. The 10-year falling to 4.3%, the 2-year down to 3.78%. And the US dollar has weakened further, while the euro rose after German Conservative leader Friedrich Merz was elected Chancellor by Parliament in a second voting round, hours after a shock defeat. And the Aussie, it has climbed to 65.1 US cents. And Bitcoin currently trading close to 97,000 US dollars. Well, the oil prices have rebounded on signs of high demand in Europe and China, lower production in the US, along with increased geopolitical tensions, with India launching attacks on militant targets in Pakistan. Brent futures rising more than 3% to settle at $62 a barrel. Copper was up more than 1.5%, iron ore up 1% to $99 a tonne, and gold has risen to a 2-week high, supported by post-holiday buying from China and concerns over potential US tariffs on pharmaceuticals. Spot gold up close to 2.5% at $3,413 an ounce. Well, to get across what we're seeing globally, particularly with the focus on US and those tariffs, I caught up earlier with Marcus Padley from Marcus Today.
Yeah, I know the timing of it is obviously uncertain, and Bessent seems to be suggesting we'll get something this week, but Trump seems to have overridden that with a rather more, hawkish commentary about how they're not going to give away too many concessions and all this sort of thing. Anyway, we wait to see. But the good news is, I think, that it's biased to the positive, isn't it? The first tariff negotiation has to be better than the initial tariff and the announcement. So you've got to hope that we're biased to the positive. But we wait to see. But I think the way the market's going at the moment, we've had a rebound from peak fear on recession, peak fear on tariffs. We've had this elastic rebound, and in the last couple of days, we just sort of seem to be sitting there. Had our rebound, thank you very much. Where do we go from here? And I have to say, the economic chaos at the moment means it's very unclear where we're going from here.
Well, and of course, that lack of clarity impacting as far as forecasts are concerned, with, as we're hearing out of earnings season in the States, that more and more companies pulling guidance.
And that is, and I think this is something you're going to see from the Fed as well. We're in a period of economic chaos. And you've seen that GDP number, which was a negative number and perverted by a rush of imports ahead of tariffs. We saw the trade number overnight with a massive jump in imports, which is what we'd expected from the GDP number. But I think pharmaceutical imports were up something like 70%. Eli Lilly and Pfizer have got 24 factories in Ireland, and they've rushed in a whole load of stuff before tariffs appear on April the 2nd. So this is the March trade deficit number. So what happens next month? Does it all drop in a hole? And it's that sort of uncertainty that I think is going to dictate that the Fed just have to do nothing because they don't know what to do, and they are data dependent, and the data at the moment is just chaotic. So I think we're in a weird period where we again need certainty. We need to see how the economic numbers are going to drop. I don't know whether you saw that fantastic article today about the first ship arriving in LA and how it had come through China, and trying to calculate what the tariffs on it were, depending on what containers were loaded on what day in what port, and when they arrived, and what goods they were, and whether there were concessions. It's just unbelievably complex and extremely expensive for anyone receiving goods in the US. And the economic impacts of this are just unknown at the moment. So the bond market is telling you, if you've seen the drop in the currency, the bond market is telling you that it's worried about inflation. The Forex market is telling you it's worried about growth. It's confusing at the moment, and I don't think that's terribly good for markets. And after this elastic rebound, we're having a bit of a think.
Well, of course, we've seen that locally too with the rebound, but also post-election too. At least we have certainty there, Marcus. But steady as she goes, do you think?
I think from an Australian point of view, the election, UBS wrote about it. And I think from an election point of view, it was a positive for our market. Just consider that the politics isn't that relevant except when it disturbs, and international investors look at sovereign risk in countries. Australia's never had much of a sovereign risk, but the idea that you've got an incumbent government getting back in means you don't have to worry about volatility. The fact that they got in with such a large majority, which suggests we've probably got another 6 years of the Labour Party, in which case they can start to think about policy rather than getting elected straight away. One of the terrible things as an English person coming to Australia is this 3-year election cycle, too short. And if it's close, then there is you spend your whole time as a political party trying to knock the other party and get re-elected. Hopefully, the Labour Party will now relax, get on with policy, and I think that election result will be seen as a positive by most international investors. Outside of that, it's not terribly relevant for the market.
And Marcus, corporate-wise, focus on the big banks this week. I've had NAB this morning, a slight beat there, but Westpac disappointed. What are you seeing there at the moment?
There were a number of downgrades on Westpac, as you probably saw. I think earnings were 3 or 4% below expectations, according to some brokers. There was an increase in costs, a narrowing of margins, and it feels a little bit like the CBA result in February. The sector had run hard into the CBA results, and that sort of topped it all out, and it's feeling a little bit like that. But maybe Westpac was a bit of a one-off. We'll see what the reaction to NAB is. But ultimately, Andrew, the banks are income stocks. They're not growth stocks. They're not trading stocks. And they are some of the best income stocks in the world. They're always a buy on weakness, as we just found out when they fell over and they've come back again. We shouldn't really be worrying about the short-term movements in the banks. Most people just hold them for income in the long term, and you buy them on weakness. This tariff dip has been a good opportunity to buy on weakness. The pandemic was a good opportunity. The banking inquiry was a good opportunity. The GFC was a good opportunity. At the moment, we're in middle ground, which is there's no reason to buy them to try and get some trading froth. There's no reason to sell them because they are solid quality stocks. It's steady as she goes, and these results, you can overanalyze them. They're all good. They are carving up 26 million Australians for a fabulous profit every year. That will continue in eternity until they see some competition, which by the looks of it, they never will.
So, Marcus, what's your positioning at the moment in your strategy fund? We know that you timed the market. You went 100% cash. You're now back in. Where are you?
Yes, we got out at the end of February, beginning of March. We reckon we saved investors about 9 to 13%, depending on which ETF we were in, and we've got back in again. So we're 100% invested. We've ridden this rebound. We made about 8.5% in 2 weeks, and now I'm sitting there wondering, do we cash up again, or do we just relax that we're back into a non-precipitous market, that we're just climbing the wall of worry, in which case we can stay invested, or is there another precipitous moment ahead? I think for the moment, we don't want to be cashing in and out. It's only during these precipitous moments. I think we're now climbing the wall of worry. If you think about it, investors worry 90% of the time. When things go well, they think it's good luck. And when things are normal, you're worrying. So that's why they call it climbing the wall of worry. I think we will now climb the wall of worry. I'm hoping we've seen the worst. I think the tariff fear has peaked. The market fear has peaked. We've rebounded out of the worst of it. From here, we're probably in a bit of a grind, and probably not a very dangerous grind, but you never know. So we'll just keep making decisions every day. For the moment, we're fully invested, hoping a mild bull market develops out of this situation. If it turns out that it doesn't, we'll do something about it. But for the moment, still fully invested, very selective about which ETFs we're in. It's not all of them, but just hoping things go okay. We'll ride the wall of worry, keep worrying.
Marcus Padley from Marcus Today. Let's check the local market, see where we're likely to get going. SPI futures are off close to 0.4%, and we'll get right across that in just a couple of minutes' time.